So building energy security through innovation. I think innovation is the key word here in the title, and it's not invention. And that's an important distinction, particularly for green tiger markets, in that what we've been focused on is not inventing anything new. Instead, we're taking some of those brilliant inventions from some as many as nearly 150 years ago and applying them to the Philippines electricity market. So I grew up outside Chicago in the shadow of modern markets, which was the Chicago Board of Trade. And that's where the corn contract was developed in the 1850s. And so from a kind of a cultural perspective, Chicago was a real markets town. So it was kind of in my blood from early days. So, but yeah, when it comes to innovation, I think there's a lot of opportunities to apply the lessons of energy markets from the U.S., Europe, Australia to the Philippines market. So when we looked at the Philippines market originally, we saw that there were kind of three critical problems. One of them was affordability. These figures are from recent prices of the Philippines versus some of their regional competitors. And that price of electricity really matters when it comes to competitiveness. When foreign firms are thinking about setting up in one of these countries in Southeast Asia, the energy cost for some industries is the primary factor that's driving the decision. So if the Philippines is more expensive or substantially more expensive than their competitors, that's going to put them at a significant disadvantage. So affordability is I think problem number one. Problem number two in the Philippines electricity market is a problem of volatility. The spot market for electricity in the Philippines is one of the most volatile spot markets that I've ever seen in electricity markets, and just a volatile spot market generally. And in 2022, in just a short period of time 2021, for a fairly short period of observation, we saw prices that had basically a 10x range over the observation period. That makes it really, really challenging for businesses to make decisions if they don't know what the price of their electricity is, or it changed by a factor of 10 in a really short period of time. So that volatility issue is a big problem. And then lastly is this issue of reliability. I've only been in town for a short period of time, and in a lot of the conversations that I've had, and actually bringing up these pictures, this is more the rule as opposed to the exception in terms of the experience of Filipinos in the last decade. That yes, these pictures, this is a part of their life. So not necessarily on a daily basis, but it does happen, and this reliability issue is one that does need to be addressed. But all of these three problems come back to essentially this chart. And we pulled this from the Department of Energy presentation from a number of years ago. The chart basically hasn't changed, but essentially the Philippines market is short generation. And obviously firms like Avoides have plans to build a significant amount of generation. It's much needed. It's obvious to, I think, the local residents that the market is short generation. But the question in my mind comes, how does the world how does the Philippines attract between 50 and 100 billion US of capital, of foreign direct investment to build this roughly 45 gigs of generation that the Philippines are forecasted to be short by 2040? that $50 to $100 billion could flow anywhere in the world. But how do they know to send it to the Philippines? Which brings me to one of the projects that I worked on at Goldman Sachs. So in the early days of my career, we were approached by ConocoPhillips. ConocoPhillips wanted to build a offshore drilling platform that was going to be somewhere around 200 miles off the coast. They were going to be drilling to search for natural gas and crude oil. And ConocoPhillips was was very confident that they could build the platform and that they could extract the oil and gas. The problem they had was they didn't know the price that they would receive for that oil and gas once they extracted it from the rock. And so ConocoPhillips contacted Goldman Sachs and said, hey, what will you pay us for this forecasted production over the next 10 years? And, it's a challenging question to solve. Obviously, we could have generated some sort of supply and demand analysis and expectations for the marginal cost of production. But we had something at our disposal that allowed us to vastly simplify putting a price on natural gas and crude oil in the future. And that was the NYMEX. And so the NYMEX is the New York Mercantile Exchange. It subsequently was purchased by the Chicago Mercantile Exchange. But when I first started trading natural gas, and NYMEX was the place where essentially all energy products or energy futures were traded. So they had natural gas, crude oil, heating oil, gasoline, electricity, basically anything related to energy was traded at the NYMEX. And the NYMEX was, if you look in here, you see essentially kind of a big ring. And all of it was primarily men, but all the men standing around would either be traders or brokers. And it was called open outcry. And the price of oil and natural gas was determined basically by this mass of bodies at the NYMEX. Now, there's something interesting that's going on here in this pit. Well, actually, there's two things that are really important. The first one is price discovery, and that is the trading that is happening for whether it be oil or natural gas. It's determined basically by the collective wisdom of all those individuals and all the orders that are flowing into that pit. But price discovery is basically when buyer and seller meets and price is determined for a good. So that element of price discovery allows for price risk transfer to happen, as well as the generation of what we refer to as a price signal. Price signals are extremely important. They are the guiding information for industry participants. Those price signals, when the price is high, that sends a signal. When the price is low, that sends a signal for certain actions to happen, particularly when it comes to commodities markets. So speaking of forward prices, when they're high, and as it relates to the electricity sector, investors add to new generation, whether it's solar or geothermal or solid fuel based. If an investor knows that the price is high for the product that they're going to be producing, capital is going to flow in there. Alternatively, when prices are low, investors tend to put capital into kind of the other side of the spectrum, which is the consumption side. And if prices were very low here in the Philippines, we might see additional steel mills show up here in the Philippines, or other energy intensive industries. And the ability to build large, spacious shopping malls, for example, that do consume a lot of electricity. But the mall operators are willing to do that because they know that the price of that electricity is low to keep that facility cool. Now, There's an issue when forward prices are uncertain. And we at Green Tiger Markets would argue that the forward price of electricity in the Philippines is extremely uncertain. And that lack of a price signal has a demonstrably negative impact on the development of electricity infrastructure in the Philippines. And so if investors don't know what the price of the good that they're producing is going to be, it's very challenging to make that investment. So in response to that, Green Tiger Markets, what we've done is, and as Ben pointed out earlier, we've built a cloud-based trading platform to allow WESM market participants that are sufficiently capitalized to participate in a over-the-counter bilateral market to allow them to hedge the price of electricity. So if they're a generator, they can go and enter into a hedging transaction where they sell. If they're a res or a DU or a bulk user, they can be on the other side of that transaction. And we've worked with a number of market participants to develop these standardized contracts. They're financially settled. And these contracts reference the load-weighted average price final as provided to the market by WESM. The market structure that we are proposing is essentially identical, and this is where sort of the innovation aspect comes in, essentially identical to the way that the forward market in the U.S. Originated in the mid to late 90s. And so we're taking the lessons learned there and trying to apply them with a little tweak to the Philippines electricity market. And so, the obvious question is, hey, why does this matter? But, when thinking about that 45 gigs of generation that needs to get built roughly over the next 20 years, there's a significant number of jobs to build those power plants, to build additional transmission lines, and to then once those facilities and transmission are built, there's a number of jobs that are in the services industry, just maintaining that infrastructure. But think of all the potential new manufacturing jobs that could come to the Philippines if firms were able to lock in some of the most attractive prices for energy. And think about the economic growth that would happen in the Philippines if we're just able to unlock that roughly 2 trillion PHP of investment. And then obviously from the government perspective, the larger economy is going to generate more tax revenue to allow for more services to be provided. And obviously, the standards of living of the average Filipino, if energy prices are lower or more stable, that will most certainly result in a increase in standard of living. But I think the real risk here for the Philippines is that they get left behind by the local competitors, and this difference in cost of electricity could be the factor that separates the Philippines from their competitors when it comes to gaining investments in additional, whether it be manufacturing jobs or just industries moving to the region. And that's a big risk to take. But it's one that's definitely solvable. It has been solved in other countries. And we're Green Tiger Markets, and we're here to help.